Thank you, Ravi. Thank you, Neeraj. And that brings us to the last session, which will be, stronger, consistent, and sustainable. That's the closing remarks by Rajiv Anand, our Deputy Managing Director. Rajiv, over to you.
So thank you for your interest in Axis Bank. I really do hope that you found the conversations today, the presentations, and the experience center enriching, enlightening, insightful, and most important to us, open and transparent. And I think we spent a lot of time. I mean, you guys know all the what's of our business. You look at our numbers on a quarterly basis. You have multiple conversations with us. But I think the focus through the day really has been on the how, and how we are doing each of the things that we've been talking about, and hopefully that is giving you more confidence in terms of the fact that we're building a stronger, consistent, and sustainable franchise as we go forward. I want to leave you with 7 key messages. Just 7 as we go forward. Much of this you've heard during the day. I'm not going to spend a lot of time, but 7 key messages is what I want to leave you with. First, this is a self-sustaining franchise where we used to consume capital 107 basis points between 17 and 23. We are now accreting capital 54 basis points in H1 of 24. And I think the important point that I want to also leave with you is that the incremental accretion of capital is actually the highest among our peers in the same, obviously in the same periods. The asset quality matrix, I think, has been well recognized, well understood. There has been a 304 basis points reduction in net NPAs, 27% improvement in PCR since March 2018, and a standard asset provisioning of 1.32% sits on the balance sheet. There was a lot of conversation at lunchtime on what are we going to do with that. We are not going to release that 1.32% of provision that we have. It's taken a lot of hard work to put it on. We have no plans to release that as we go forward. In the opening session, Amitabh also spoke about the fact that I think there's been some conversation, chatter around whether the asset franchise will sustain through cycles, and I think there's been data that's been put out about the fact that if you just look at the retail side of the balance sheet, it's performed significantly better than peers over the period post COVID. NIMs have structurally improved. We have demonstrated that there has been at least a 25 basis points improvement in NIMs through the cycle. Yes, we've benefited from the higher interest rate environment as well, but that improvement has come by some structural stuff that we've done which is unique to Axis, which is not benefits that we've taken from the system. A 700 basis points improvement in retail and SME, 600 basis points reduction in the non-INR, the FX book, a 300 basis points reduction in RIDF, and I think there is more to go as we go forward, and a 400 basis points improvement in CASA has really driven this at this point in time. And I think the other thing I want to certainly emphasize a lot more on is the fact that NIMs have improved because of the structural changes that we've made, and it has come without taking on incremental risk. So if you see the RWA intensity, it has remained stable during this period where NIMs have significantly improved. If you look at the revenue stack, NII plus fee, you'll see an improvement in this as well. There has been a 600 basis points improvement in the revenue stack as well, meaning that the amount of the more volatile, trading treasury incomes has reduced in the overall income stack, and where that number used to be, as low as 87%, today the core of the business is delivering, close to 97 odd percent. So that's been a significant improvement in the quality of the granular franchise that Axis has built And so therefore, by definition, the revenue streams are that much more predictable, that much less volatile as we go forward. There are multiple themes, and to some degree, this has been picked off many of the reports that you guys have put out. There are multiple themes. Whether it's the SME opportunity, that's one opportunity that I'm actually very, very excited about. The digital and payments ecosystem. There's a lot of work that's already happened, but I think if you broadly believe that cash is the enemy, we've got a long way to go in this country. Rising affluence. And of course, the whole infrastructure, private capex piece. You will find that in each of these, while I don't think there's any argument on the fact that the size of the opportunity on each of these is very large, you will find that we are very well positioned, not just well positioned, we are very well positioned to be able to capture each of these opportunities as we go forward. And I don't think there's too much of an argument that this will play out. I mean, one could argue on how long it will take to play out, but I don't think there's any argument that these will play out, and we strongly believe that Axis is well positioned to be able to benefit from each of these opportunities. Risk, I think we spent a lot of time on risk. I mean, ultimately, we are a highly leveraged business. Therefore, risk is core to everything that we do. We spoke about the fact that we have a institutionalized risk appetite framework now, which is not in a sense open to discussion at a business level. This has been approved by the risk management committee of the board. So any changes to our risk appetite statement needs to be approved by the board. And so therefore, the way we think about risk is granular across both sides of our businesses. And we are also increasingly spending more time on risks which are not necessarily emanating from the business itself, but things like cyber risk, climate risk is increasingly becoming important, both for our Bharat banking franchise, for SME franchise, as well as the large corporate businesses. Digital risk. I mean, we've seen over the last few days itself, we've seen some instances of the way digital risk could potentially play out. And so therefore, there's a lot of time and energy that is being spent on how, I mean, the way that you thought about risk traditionally and the way that you need to think about risk as we get into the future is perhaps going to be very different. And we are, I mean, obviously, risk is the unknown, and so therefore, we do spend a lot of time trying to figure out what is it that could potentially hit us as we go forward, and see whether we have mitigants internally to be able to manage each one of those risks. We've just finished the deposit presentation. The franchise has significantly improved, both in terms of quality as well as in terms of quantity. We just had that conversation around outflow rates. The outflow rates are now pretty much best in class. In terms of quantity as well, if you put it all together, growth is broadly best in class at this point in time. CASA to average assets, if you compare it against peers, we are significantly better, and gives us the confidence. Ravi spoke about the multiple initiatives that are on. It is going to be a battle for liabilities over the next few years. One of the questions that Kunal asked as well is liquidity going to get easier anytime soon? It doesn't look like that situation is going to play out, especially the way global interest rates are currently playing out. In which case, it then becomes a market share game. As far as we are concerned, to be able to get that the liability stack in the shape and form that we want. And I do hope that the initiatives that Ravi spoke about gave you the confidence that we should be able to gain market share as we go forward in each of these initiatives. Digital it's not a transformation project for us. It's the way we think about all our businesses. It's the way we bring it all together as far as the customer is concerned. So it is whether it is on the retail side where multiple products and services are being catered through the digital app. Samir showed you that 13 million customers going through that, transacting 15, 16 times every month. Similarly, there is projects going on and customer adoption that's happening on the corporate side as well. And I did mention to you, when we were having that conversation around deposits, that for a current account, for example, I mean, nobody leaves balances in a current account, right? I mean, you want to see throughput. And so therefore, for us, one of the things that we are always focused on is to see how much of throughput we are getting of the various payments and collections that a corporate is making, and that in turn, inevitably converts to balances on the current account side. And you will find that our market shares on all things digital are disproportionate to the market shares, our traditional market shares, which is 5% on deposits and 6% on assets. But on the more, let's call them more sophisticated transactions, we have a disproportionate market share, and that market share even incrementally continues to gain as we go forward. That once again gives you that much more confidence that our ability to continue to build on the deposit franchise is very, very strong. And it's all that we have done. We are well positioned to be able to take benefit of the various large mega trends that are sort of going to be playing out. And you will find that increasingly, as we get more focused on execution, as we get more ambitious, we are gaining market share in many places. We are a leading wealth manager. You would have seen that from Arjun. The CASA franchise is now among the best in class. We are the fourth largest on the credit card side, closing very, very soon, hopefully, to third place there. The SBB SME MC has scaled up very, 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 very nicely. It is a granular business, well diversified, both in terms of sectors. It's approximately 35, 36 sectors, and it is well diversified geographically. Obviously, as you deal with the smaller corporates or smaller companies, mortality rates are relatively higher. But one of the things that we are very focused on is to ensure that granularity of that business continues. There, once again, the risk appetite statement kicks in. How much we can lend to these little companies is now controlled from an institutional perspective, and so therefore should give you confidence that as we continue to grow this business, it should play out as anticipated. The world's highest rated mobile app. Obviously, we are absolutely delighted the way this is played out, and it's a journey. The way that the mobile app looked 5 years ago was very different from the way it looks today, and the way it will look 5 years from today. And therefore, Samir and team have the capabilities internally to be able to deliver to changing technology and changing customer needs. And I think that I think is very important. We believe that digital is a journey, because customer expectations are changing on a continuous basis, and you've got to ensure that you are staying up and meeting those customer expectations at various points in time. Technology is changing. We are not creating biometric or face recognition, but as soon as it is Apple or Samsung creates it, it becomes an imperative that we incorporate it into our app as well, because ultimately that's what the customer expects. The wholesale bank franchise, I think it's a fundamentally different wholesale bank franchise than what it was 5 years ago. There used to be so much conversation around this, but the entire risk culture has fundamentally changed in the wholesale bank. 89% of our portfolio is A- and better, and I do hear some questions on, are you going to take more risk? I think yes, we will take more risk on a granular basis, which is really the box above, which is the SBB plus SME plus MC, is the granular, relatively lower rated risk business that we will do. it is, you will not see lumpy wholesale bank low rated risk being written hopefully anytime in the future. But having said that, we do have the capability, we have the distribution, we have the reach, we have the brand to be able to build granular businesses like SBB, MC, and SME. And that is what we will continue to do. This is, and I really like the point that Amitabh made in the morning, that there are multiple projects that we are doing which may not necessarily impact a single business. That there is, because of the fact that we are doing, Bharat Banking or digital or partnerships, and let me just spend a minute on partnerships, because I think it is a bit underappreciated, that there is a lot of conversation around, whether we're going to open more branches or not. But the corresponding argument to that is, are you able to get to different cohorts of the liability franchise through multiple routes? And when we talk about partnerships, it's not just, let's say a Flipkart or an Airtel partnership. You'd have heard about the 64,000 VLEs that we have in Bharat Banking as well. Bharat Bank, the point I'm making is that there is Flipkart at one end and VLEs at the other end. And so therefore, as a philosophy, we believe that partnerships is going to be a key element for what we do. And I think partners like to work with us. I think we're just about, the right shape, right attitude. We do treat them well, and therefore we do find that partners like to work with us. And by definition, we like to work with partners as well. And we do spend a lot of time, to see which partners we want to work with, what do we want to do with them. And we also now at an institutional level have a partnership team, which is really looking at, so far we used to look at, hey, with Flipkart, can we do a co-branded credit card? But now the relationship is getting much deeper. The cards has become, personal loans. Going forward, we will do fixed deposits, we will do savings accounts. The wholesale bank guys have a big relationship on the other side. And therefore, we are choosing a set of customers as well, where the partnerships will become a lot more strategic. And you will, over a period of time, either hear about it or will be able to, perceive that difference in terms of, partnerships as well. So this is, to me, it's a big differentiator. You'll find that many of your peers are not as deeply entrenched into partnerships as we are. And to us, this is core to, everything that we are doing. We will continue to invest both time, energy, management time, to be able to build out partnerships as we go forward. It has a multiplicative force benefit as a result of that. And finally, the investments in our long-term distinctive drivers. We chose 3: digital, Bharat Banking, and Sparsh. And each of them is playing out as anticipated. Digital, we already have a preeminent position. We will continue to build on that. We have the internal capabilities to be able to do that. You saw the technology stack that is being built for us to be able to bring that simplicity to the front end. I think one of the things that what all of you see is just the mobile app. Today, you've seen what is being done at the back end by Avinash and team to keep the complexity at the back end for us to be able to deliver the simplicity at the front end. And that's really the point I was making about the what and how. The what is the app, but the how is what Avinash and team, they demonstrated to you in terms of, all the stuff they're doing around cloud and, stuff like that, that is helping us deliver the front end. Sparsh is a 10-year journey. The progress so far, I think we've been able to, pluck some of the low-hanging fruit. But I think it's fair to say that as we continue down this journey, our ambition really is that that people will actually be talking about the quality of service that you get out of Axis Bank. And so finally, here is something that I want to leave you with, that if you looked at 14-15, the balance sheet looked very different. The matrix looked very different. NIMs were very different. But I think if you also look at the maximum price to book during that period for us was significantly higher than what it is today. So if we have narrowed the gap significantly to peers, if we have demonstrated to you that we are future ready, I see no reason for this gap to continue as we go forward. Thank you, ladies and gentlemen.
Thank you, Rajiv. We have the entire team of presenters from the morning. Okay, Suresh, go ahead.
This is a very generic question, and of course, you being one of the largest players in the market, the next 5 years, as you guys have rightly pointed out, the biggest challenge is resource mobilization. I'm just hard pressed to find out how are we going to solve this problem, because if the system is growing at 18-19%, if the system wants to grow its loan book, and if deposits in the system are only growing at 12%, how are you guys going to manage the resource mobilization? I mean, it's applicable for the system, it's applicable for you also. And also what's happening, Rajiv, here is that you're seeing competing products, right? Mutual funds, equities, which weren't there 10 years ago. Statutory appropriations have come down from 40 to 22. 22 is not going to come down any further. So even those levers which were there 10, 15 years ago, unfortunately no longer exist. So how do you solve this wedge between loan growth and deposit growth?
So as far as products is concerned, see, ultimately money that goes into a mutual fund or insurance is money within the system. So to that extent, it's just an allocation of money. But simple arithmetic is that if deposits don't grow, by definition, yields on assets need to go up, and we'll probably need to go up to a point where asset growth can no longer sustain where it is today, because ultimately banks are a marginal cost business. So if my cost of funds is going to go up, I need to pass that on, and ultimately that's really the way the cycle has to play out. So if deposits don't grow, it is inevitable that over a period of time that asset growth will not happen. I mean, simple.
Chintan, go ahead.
While someone asks the question, I would just like to add that Suresh, and that's why you need all kinds of distribution channels. You can't rely on physical, you just can't rely on digital. That's where a partnership comes in. That's where, for example, we have deep relationship with a lot of venture capital funds. They have their companies. So we are not relying on one strategy. We believe that the future would be open architecture, and in an open architecture world, we need to do our own things, both physical and digital. We need to have partners, we need to have strategic relationships, and that's where the kind of investment of the bank is going. So our hope is that even if it falls to 12-13%, we can hopefully deliver more, because we just have a larger ecosystem which is feeding into us. Sorry.
So just following up on Suresh's point, and then one on cost. Is there a role in the Indian banking system for wholesale funding to take a bigger part in this wedge? Or are we just attuned to thinking about loan deposit ratio, and that's the way we grow?
See, I think Neeraj gave you a 101 on LCR. The most precious is retail plus small businesses. The outflow rates there are 5%, which by definition means that it is 20 times more precious than money you get from a financial institution, which is 100% runoff. So, one. Two is, no bank can get built on the back of volatile wholesale funding. I mean, if you see many of the mishaps that we have seen on NBFCs, for example, over the last 20 years, by and large, they've come from the liability side. So no bank can be built on the back of volatile wholesale funding, which is here today, gone tomorrow. We can never do that.
If it is kind of 5-year money?
Doesn't exist. So, I mean, for a 13 lakh crore balance sheet, that size doesn't exist in India.
And the second.
Don't forget the regulator.
Yeah. Yeah. On the cost point, I think the community here have asked you in different ways on kind of what your investment plans are, and there is clearly a lot of investment going on, and it's a tricky question to ask you when do things normalize, because we are in a growth economy, so there will be growing needs for investment as we go along. There was that exit run rate number of 2.1 cost to asset. I mean, should we just think about this now as kind of jaws or something like that, or do we still kind of gravitate towards a cost to asset, or we forget about, just trying to think about how you think about it so that we can think along similar lines.
Thank you for the question. I think the way we are thinking about it currently is the environment today is allowing us to continue to invest for the future. You've seen what investments in the past have delivered today. And those were investments made for the future when made. The benign environment is allowing us to invest. We do believe that we will continue to invest. And that's how I would like you to think about costs.
And I think let me add to what Puneet said. We did say that on the top of the house of pyramid, which or the house of GPS, which Rajiv just showed as the first slide, we had 18% ROE. So if we can maintain our performance at that level, I know it is important that there are components which kind of add up to that number, but we would like some flexibility on those components, and we're not trying to guide anything different. Yes, we talked about that exit rate. Yes, if you do the maths over a period of time, all of them need to converge to some of the numbers that you've talked about. But if we get some flexibility as a bank, I'm not talking about asking you, I think we'd like to use it as long as you maintain that number, because it is all about the future. All the investments you're making, and invariably the large investments you're making, are with a 3 to 5 year horizon in mind. We are not transforming incrementally, we are transforming each of the businesses. They're invariably 3-year projects, and they have a phase 1 and the phase 2 follows after 3 years. And that's why what you saw outside in the stalls is a 3 to 4 year journey. And we're still not done, right? So that's what I think Puneet is trying to say. But it's not that we have lost our clear focus on getting it down. We have to finally get it down, and we need to be able to invest at lower levels of cost to assets. It's not given up. But yes, we are watching and talk about it practically every day.
Thank you. Thank you for the day as well.
Saurabh, go ahead. Mike, please. Yeah, Saurabh.
Hi, sir. This is Saurabh from JP Morgan. Sir, just your last 5 quarters, you delivered a 18% ROE. My point is, effectively, if let's say your credit cost, your net normalizes to gross, and in case you get a rate cut, do you think you can still maintain this ROE trajectory?
So much maths, I don't know. Puneet?
No, Saurabh, I think, look, there are items in the DuPont that we need to work through. And we've said the aspirational ROE is 18%. We are committed to it. The honest answer is you didn't believe us when we said we'll get to 18%. We've delivered 18% to you for 5 quarters. So trust us to do the right thing. We're fully aware of what the market environment is. We will work to ensure that we get the right outcomes for the franchise.
So if you were to step away from the maths, and obviously there is a maths behind it, what have we tried to tell you today? That there are businesses which are at a certain level, they have come to a different level, and these are businesses which are more profitable. So let's say we can continue to build those businesses and continue to, some of the businesses which are slightly behind today, continue to work on them, and as you're investing for the long term, they continue to come up the curve. There is inherent pool of profitability which is potentially available if we get the execution right. So, we have, what we try to demonstrate is in 4 years, this is where we have come. If we can keep on executing well, and you've seen all the management team, all of us sitting here, so it's collectively we are responsible, we can continue to do that in the future. It's not that because you've hit the peak, you've still got a long way to go. I mean, look at our deposit, advances market share, and in each of the businesses, what our market share is. There's still a lot that can be taken away from others. And that's why there is, while it's an aspirational number, we believe that if we keep executing, these numbers are possible.
Yeah, Param, go ahead.
Yeah, this is a broader question again. Now, since you're talking about, resource mobilization being a challenge going ahead. Now, going ahead, if we say had a trade-off between growth and margins, which one would we choose? Bit of a tricky question.
It's not a trade-off. Both have to be done. That's a question we keep getting internally also all the time. And I'm saying at 6% advances market share, what trade-off are you talking about? Where is the trade-off? Why can't you deliver growth and the margin? If we were at 20%, I could have understood that question. At least I'm not able to understand. So
No, it's coming from the
thankfully, people have
perspective
stopped
that-
coming to me, but...
No, I meant that, even the LCR, we are within, our range.
Yes.
LDR probably at a 5-year high for us. So, and clearly you're talking about a resource mobilization being a challenge, right? So, say going ahead, we do have a trade-off.
So Raji did make the right point that if tomorrow, let's say the deposit mobilization is where it is for the industry and then kind of flows to us, then at some stage the asset growth will suffer, for sure, yes. And that's why, again, please think through. So what are we doing about it? What kind of investments are we making? We are looking at the wealth franchise which you're trying to grow. So yes, then if, let's say tomorrow, for magically, that the asset growth gets limited by deposit growth in the industry, what choices do you have? You grow businesses where deposit is not required or it's not a constraint. So you start focusing on businesses which can potentially give you a fee or something which where a deposit account is not there. And that's where the wealth, for example, the wealth management franchise plays up. Some of our subsidies play up. So that's what I'm saying. We have a lot of things going. It's not just one thing we are relying on. But you are asking exactly the right question that if deposits will dry up, asset growth, we've been saying it openly in our calls, asset growth will suffer. There's no magic about it. I don't know why people are just saying that, no, it doesn't matter what the deposit growth is, we can continue to grow assets at a particular rate. It's not possible in the long run. And as Rajiv said, wholesale funding is not available. If you rely too much on borrowings, RBI is not okay with it. I mean, they're okay within a certain zone. You can't just, go running all over the place and do stupid things. They'll not be okay with it at all. For everyone, why us?
Fair enough. Very clear. Thanks.
Partnership?
All good. All very good. I don't know what comments you're hoping for. We have applied to IDA for increasing our stake. That process is still on. We have now the right to appoint a chairman, which will get announced very soon. We have the right to appoint more directors. That will also get announced very soon. We are taking more active interest in how Max is doing. I think you can already see it in the numbers that there is an uptick in terms of how some of the business numbers are picked up. Yes, slightly at the cost of margins, but we do believe Max had lost its market position to some extent and want them to regain it back. It's a franchise and a management team we believe in, and we are fully supportive of how they're planning to execute on it. Subrat, anything else?
So you will push it over your other banker?
Absolutely, why not? We want to reduce the reliance they have on Axis. It's a business, that business should be run independently. Obviously, we are supportive. Obviously, we'll give them a certain amount of or try to ensure that a certain amount of business from Axis is going to them, but otherwise they should stand on their own feet and run as hard as possible.
Mark, just to supplement what Amitabh said, I think the focus we have is customer first. So to your question, because you used the word push, I just want to clarify. We will give the customer the right product. The customer buys the product that suits their need.
Okay, that's fair enough. My second question really is that after COVID, anyway, there were heavy recoveries after things settled down. So why is net credit cost still settling so low for the sector?
So Maruk, I think what we've always maintained is in this cycle, you will see credit cost normalize first and then asset quality rear up if there is a subsequent cycle. The gross credit cost for the system as a whole has, if you look at the tail of the curve, has been moving up, but marginally. So it's trending in the direction. The reason net credit costs have been low is all of us had large pools to recover from, both retail and wholesale. So recoveries and upgrades have been good. Our view is the way this cycle will play out is net credit costs will trend towards gross credit costs first. And then if an asset quality cycle plays out, you will see gross credit costs move up. But that's a function of asset quality playing through. The way we see it on the Axis book is we're not seeing anything today on our portfolio that gives us any discomfort that we are seeing a credit cycle come through for our portfolio.
Got it. Makes sense. Thanks.
Any more questions? Okay, so Maru concludes. Okay, thank you everyone for joining us. Request you to sort of, give a feedback. We have the QR code there. I would like to thank, all of the presenters today and, all of you coming and sort of spending time with us. On the way back, please, there's a giveaway for you guys. Please take that. And we are all available. Please join us for high tea after this. Thank you so much. Thank you.